Wayne lands there with just the most beautiful property. And for those of you that like to look at that horse property, I'm involved with that one as well, and that is one magic home. Now, for those of you that have been following the market, RP Data put out a report, some monthly report, really interesting material in that. So we've got on the line David Williams, who is the Executive General Manager of RP Data. Now, RP Data are actually the people who consult to the Reserve Bank of Australia. So I guess the first question you might ask is, what's the information they're getting? Because I've put the rates up again. But let's get into it. So we've got David Williams on the line now. So David, just give us a bit of an update. Firstly, before we get into the real questions, what part did you have in this extra %.25% rise yesterday?
That's a very good question. Unfortunately, the answer is not much at all. I mean, all we're doing is reporting on the data and what's happening in the marketplace at the moment. And we've got a large client base of agents and valuers and banks that want to know what's going on, and we measure the market. So unfortunately, we've got no influence over the results. We're only measuring what's happening.
Good on you, David. Now, I know that you're absolutely frantic today with doing interviews and that, but give us a snapshot of the Australian property market. Pretty bullish report that came out yesterday.
Yeah, quite surprisingly so. I mean, over the first 10 months of 2009 this year, we've seen Australian home values have now risen by 10%, following on from their 3.8% peak to trough falls in 2008. So what we are seeing is a strong recovery to the market. The figures in October were strong after a slowdown in September, and it showed that the market's still very resilient despite the 25 basis points increase during the month that has not seemingly had an immediate impact.
So David, how has the recent rate rise impacted the market?
Well, the last rate rise seems to have not had much of an impact in terms of house prices, and fundamentally that's because the underlying factors affecting the growth in house prices have probably got more to do with supply and demand and employment levels than they have with the price of money. I mean, in terms of interest rates at the moment, historically they're still relatively low, still well below the average levels, which tended to be about or above 7%, and significantly lower than the peak when the mortgage rates were at 9.6% in July and August last year. So the fundamentals that are driving this are a population increase and a lack of stock in the marketplace to actually soak up that increase. And you can see that also too in the high levels of rental prices at the moment as well.
So in essence, what you're saying is this hasn't actually surprised you that the outcome's been so good?
It surprised us a little on the upside, considering that obviously we've coming out of a global financial crisis. We did forecast in our numbers that there would be a housing shortfall. We also did say that obviously if that wasn't addressed, that would put pressure on the supply side of the market, because demand was always going to come back at some stage. Because the supply side hasn't been addressed, we're seeing increases in capital growth quite stronger than probably most commentators and analysts would have expected this year.
David, a bit of crystal ball gazing. Where do you predict things are going to go in the next 12 to 18 months?
Well, that's the million-dollar question, and unfortunately, predicting property prices is probably something that we stay away from. What I can tell you though is that obviously the fundamental factors underlying the capital growth in the market at the moment aren't going to disappear quickly. The increase in population that we're seeing now isn't going to change quickly. The lack of supply in the market isn't going to change quickly, because we've got a lack of infrastructure, a lack of incentive for developers to go out and develop. So those fundamental underlying factors aren't going to be removed quickly. We've also seen employment levels remain relatively strong compared to most Western societies that have been through the GFC. So if employment levels hold up and confidence holds up and supply isn't addressed quickly, then the only forecast I would be prepared to say is that the conditions of capital growth aren't going to change all that quickly, and therefore you could surmise into that we're probably headed for a couple of years of some modest growth in some markets and maybe more aggressive growth in others. We've seen in the last 10 months the Melbourne market surprise probably the greatest, with Melbourne growing 14.9%, and the national average is about 10%. So you can see there that's an extremely strong growth in one market in 1 year.
So David, the maximum growth or the ultimate growth has been Melbourne. Sydney, from the report, slightly behind it. But talk to us about Adelaide. What are your thoughts on Adelaide?
Yeah, Adelaide's had a reasonable growth at 4.6%. And probably that's not because Adelaide's performing poorly, it's probably because of where it is in the cycle. I think we saw Perth and Adelaide actually peak a lot later than Sydney and Melbourne, and therefore we're probably seeing those markets flatten a little later, and therefore they'll recover a little later too. But on top of the growth in Adelaide over the last couple of years, 4.6% is still a strong effort.
And David, just very quickly, with this last rate rise and also being added to by the majors, or certainly Westpac at the moment announcing today, or yesterday actually, what's the scenario on the first home owners buyers from your point of view?
Yeah, well, the first home buyers grants obviously being cut back gradually in stages, so the incentive to act now is being removed from the marketplace. Remembering that first home buyers are around about a quarter of the market, so the movements we're seeing right across the market are not just in first home buyer dwellings, but they're also in the middle market and they're also in the top market. So if we look at market growth in terms of those three markets, you can see that since February 2008 we've seen Australia's top 20% of dwellings increased by 11.9%. The middle market increased by about 10%, and the bottom 20% in terms of price range still increasing by 8.5%. So yes, there has been some accelerated growth or bringing decisions forward by the result of having such significant incentives for first home buyers, but it's certainly what's not driving the majority of the market.
And finally, David, what's your thoughts on double dip? You know, where America, they're still saying could go into another, hissy fit. Any thoughts on that before we let you go?
Yes, certainly. I mean, look, the first thing is we're a very, very different market from America. Our financial systems are run much more tightly. In America, you had the situation where loans were being sought by people that probably would always have trouble repaying those loans, and if they didn't and couldn't repay some of those loans, they could literally walk away from them and they would be the bank's problem. In Australia, we don't have that, and thankfully, that is a major contributor to why our market has actually performed relatively strongly. Plus, of course, we've got a very strong, relatively strong economy in terms of resources and in terms of general business confidence, and that's reflected in the probably lower than expected unemployment rate that you're seeing reported on a month-to-month basis. So, I would have to say that, parallels to the American market can be very, very dangerous when the fundamental variables underneath that are driving it are significantly different. So, the lucky country, yes. Will it continue